When it comes to ETF investing, it can make you a millionaire over an extended amount of time. And in today's video, we're going to be looking at Invesco and their 3 perfect Invesco ETFs that are set for retirement. So if you're not familiar with Invesco, they're the 4th largest ETF issuer in the world with over $500 billion just behind BlackRock, Vanguard, and State Street, which all of those we covered. And of the $500 billion in the ETF, half of those assets are in one single ETF, which I do personally hold in my portfolio, which is the Invesco QQQ ETF. Now, you've probably seen a lot of commercials on TV for this. I know I have as well. This is a very heavy growth technology kind of focused ETF, which is based in the NASDAQ 100. So a lot different than what we see of the S&P 500 funds that we've talked about before. But of course, when you start look at this, that is the flagship fund for Invesco, which of course they do have 200 other ETFs as well. Now, of course, the Invesco is different than Vanguard, then State Street, then BlackRock. This is where the company kind of has some diversification on the equity side. It really is a factor, and Theometric plays, it really has fixed income on one side of it. And if you look at this, they also have an Invesco Galaxy Bitcoin ETF. Now, this is the second one that we reviewed that does have the Bitcoin ETFs that are offered. Now, of course, there are a lot of different exposures, different portfolios, different ETFs. And again, in today's video, we're going to be looking at the 3 perfect Invesco ones, starting with, of course, the number one. And this, again, is the one that I personally hold, the Invesco NASDAQ 100 ETF. Now, this one is actually the QQQM. So the QQQ is the one that we always hear about. Half of the assets are in there. This is the exact same evaluation or exact same kind of lineup as the QQQ, but this is the QQQM, which is a much lower management fee, which is the big reason. So when we start looking at the expense ratio, it is a lot lower. Now, we can argue whether you're going for tech, whether you're going for growth, whether you're going for value, really going in there and figuring out what you want to when you start dollar cost averaging into this, which is exactly what I do into the QQQM, you are in a very good place. So over the last 2.5 years, I've yielded about a 60% return with the QQQM. And of course, the big one, when you look at QQQ, the expense ratio is 0.15, which looking again kind of at ETFs could be a little bit lower. Now the alternative or the QQQM does come in a little bit lower than that. And then of course the QQQM has grown exponentially in size, which is very cool to see, which again, that is why my personal portfolio that we have over $100,000 invested in, I do hold that QQQM. Now the second one we look at is the Invesco S&P 500 equal weighted ETF, or RSP is the ticker symbol for this. Now, this is a different one. I want to explain this one, guys, because it is an equal weighted ETF. So when you think of the VOO, when you think of the SPY, when you think of the IVV, they are focused on the market, the S&P 500, which this one is. However, there is a very, very distinct difference with this, is when you start looking at those S&P, they are market cap weighted indexes, meaning that when you have 500 essential companies within there, you're going to have the biggest bulk in the largest 10, which is normally what we see. Now, this is where the difference comes in with this specific ETF, the RSP. This one is based on the equal weighted cap. So of course, when you look at this, it is going to be crazy kind of different to see. When you traditionally look at the S&P 500, over 30% is just in 6 stocks. When you start looking at Microsoft, Apple, Nvidia, Amazon, Facebook, and Alphabet, that is 30% of the entire S&P if you're thinking about those market cap weighted indexes, which this one, the RSP, is the perfect option for this because it is equal weighted. That is right. It is not going in there if you're holding essentially a certain percent of a larger stock and a smaller stock. It is going to be an equal weighted across the 500 components and eliminates really the concentration on those larger companies because it's still the S&P 500. You're still staying in 500 large cap stocks, but you are going in and really breaking this into putting the RSP in a much better position, because what happens essentially when you look at some of those very large companies in the S&P 500, if we see the tech actually start taking a little bit of a dip, the portfolios can jump incredibly. There can be a ton of fluctuation in those portfolios when you look just at a couple of super large cap stocks as a whole versus going in and equal weighting all of the 500 companies. So you're going to have some that are up, some that are down. And again, you're not going to have the tech sector that is really pushing exactly the performance of this ETF. And the final one we look at is the S&P 500 Quality ETF. Ticker symbol is the SPHQ for this one. A little bit different because this one is kind of the logical mention for the bonds, for diversification, fixed income fact, really. A lot of markets, a lot of sectors of funds. Now, this is also focused on treasuries and junk bonds like we normally see. When we looked at Vanguard, when we looked at iShares, when we looked at all of those, they do a majority of them in treasuries. So when you think of big picture, looking at government, there is a big part of treasuries that are involved. And of course, when you look at the total bond market option, looking at the equity side of it, probably don't need to spend a lot of time why it's a good factor focusing on the retirement portfolios. But if the S&P 500 targets the largest, most successful companies in the world, the SPHQ essentially pulls those out from the financial situations, generating a bigger cash flow and really tilting the portfolio for a good to better rating. Now, as you can imagine, it has a little less volatility than we see with the S&P 500, but it's also a very healthy tech component. So that is a big part to remember. We've seen kind of the bond market. We've also seen some of kind of the growth factor like the HD, which might have some in the larger tech company, or it's a combination of kind of the dividend side and the growth side. We've seen some combinations, even looking like at a JEPI, the JEPI, it actually focuses on some of the options in there. So there's a ton of different ways through ETFs to actually spin this to make it work incredibly well. Now, looking at this one, 35% of the portfolio is committed to the tech sector, and four of the top seven are the Magnificent Seven that we do now know very well, which of course Tesla, questionable where exactly they're going. But when you're looking just at Invesco, a lot of investors, really three big issuers in their portfolio. Now from Invesco itself, personally, I just hold the QQQM. I do not hold any other ETFs in here. But if you look at Invesco as really a broad company that issues ETFs, of course, with the exception of the QQQ, which is 50% of the 500 plus billion essentially that they're having. QQM is the exact same product, just at a much lower expense ratio, which is the reason why I do invest in that one. Now with Invesco having over 200 ETFs, it's a great opportunity to invest. And of course, when you're looking at ETFs, it's really good to do comparisons between all of them, looking at all the different companies. So it gives you the ability to kind of pick and choose, because we've ran through a lot of them. We did the Vanguard ones, we did the Fidelity ones, we did the iShares. There's a lot to go in there. We also did the iShares with the BlackRock ETFs. Overall, when it comes to ETF investing, it is really the way to create diversification in your portfolio. Very impressive looking at some of them, again, that are a little bit different than what we normally see. A lot of State Street is very similar to Vanguard, which is very similar to iShares. Invesco does have some very unique kind of focused ETFs that are out there, which again is the reason why I buy that QQQM. It has done incredibly well in the last 2.5 years. And for a growth ETF, it is one that I absolutely recommend. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.